Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. Hope you had a good Thanksgiving holiday.
It was terrific in Canada 6 weeks ago, and then I'm just digesting what I had by now, so I get to watch Americans panic over Thanksgiving. Canadians don't make as big a deal out of it. It's not as close to Christmas. It's more of just another day off than you really have to travel across the country to see friends and relatives. In the U.S., more people travel for Thanksgiving than they do for Christmas.
Yeah, they certainly do, and I saw a headline said it was the biggest travel day, since the COVID stuff started in 2020.
Now, I wonder why that is. Maybe it's because at Thanksgiving you can get together with friends and family, but you don't have to give them a gift.
Yep, you get free food.
Yeah, free food. That'll get folks in the door any day.
Mm-hmm.
On the major markets in Canada and the U.S., Friday was in the red. Tuesday started off the day in the red again on the major indices. What's happening here? Why the panic? Is it because there's a new variant out there?
Well, I think that's more of an excuse to do some selling in the markets. It's not clear, what the ramifications of that news even is. But one thing that had been happening anyway is that the corporate bond market and the junk bond market had been trending down a little bit for 3 weeks, really, and they can lead the stock market lower. And also, since the summer, the internals of the market have been very poor, meaning that the number of stocks going up versus going down has been bad for the market. More stocks have been falling, even though the market averages were going up. And my favorite indicator to track this is the percentage of stocks trading on the New York Stock Exchange. In June, it was 85%, but before Friday, that indicator had fallen to 60%. And now, as we're speaking, it's 50%. So more, the market has been driven, over the past few months by fewer stocks going up. And anyone who, has a Robinhood account and can log in and see the top 100 positions, most of those have been doing awful. And if you don't have a Robinhood account, you can look at the ARK ETF, ARKK, and it hasn't been going up either. In fact, as we're speaking, it's at a new low, since about May. So when you see more stocks going down than up in the internals, at some point that can make the stock market go down with it, because the generals, the leaders, so to speak, pull back too. And really, over the past few days, everything has been pulling back just about. I mean, one of the big leadership things has been the energy stocks, and now they have pulled back with the market. The good news about this is that historically, when the internal indicators, as long as you're not in a bear market, when they get down to 50, this percentage of stocks by the turn-day moving average, typically you'll get a bounce back, a rally that will at least take that indicator up into the 60 to 70 range, and that's assuming the worst-case scenario that this is like the end of the bull market. This is the final bounce or rally. But even if that's the case, it would probably last into the end of the year or well into January and maybe even further than that once it gets going. And I'm hopeful it can get going very soon, if not tomorrow, then by the end of the week. The other short-term positive for the market is that the VIX indicator, which they call the fear indicator, it's spiked up to levels that the market has made major bottoms and end of corrections all year. It went up briefly above 28 today. It did that Friday, but it's the percentage move that's also important, and it's up well over 50% in a week. And typically when that indicator spikes like that and gets to these levels, it's a sign of big fear in the market, because what it does, it measures the premium that options traders are paying for volatility. And when the market scares some people, instead of selling, they'll buy puts to hedge their positions and thereby drive this indicator up. And that's exactly what we're seeing. Again, that type of behavior typically coincides with the end of stock market declines. So again, it's a big sign to me that, this is sort of like a fear washout taking place, and I expect we'll see the market stabilize and be okay. It's what happens after that I would be more concerned about, what we're facing next year in the financial markets, because I think, the trend of inflation that we've been talking about together is a real one, and at some point it will have a negative impact on the broad market.
And of course, when we have high inflation, the central bank solution is always higher interest rates. Some people said the market went down today because Powell was sounding more hawkish, but the Fed has given so many hints and even said, next spring, hike rates are going to start going up. How many times they go up, we don't know, but we know next spring they're going to go up at least once.
Yeah, that's exactly right. And frankly, they need to. I mean, the inflation rate in the United States in the last annualized data was over 6%. In fact, this morning it came out that Germany's inflation data annualized was over 5%, and it was the same across almost every country in the European Union. And with interest rates at zero, you're going to create more and more inflation the longer the situation is. Interest rates do need to go up, and in order to stop that, and people got to ask themselves, what would they rather see? The stock market fall 10 or 20%? If that requires the cost of goods to jump up, 10% a year, your grocery bill, your every bill you got, rent, gas, on and on and on, just to keep the stock market going up. I mean, that's sort of silly. And I think it's just, this is the cost of the low rate policies, all the money bond buying they did, over the years, and just accelerated through the moon, last year. And, it's just not a sustainable thing, and nothing is free. I mean, it was fun for stock traders, last year, to benefit from that, but it's not so much fun anymore. But I really think, what we're seeing at the moment is a transition into, as you mentioned, rate hikes to come and how the various markets will react to that. In the stock market, when you get into the end of a bull market, it tends to get more volatile. In fact, we saw a failed breakout now of the Russell 2000 over the past couple of weeks. The IWM ETF that tracks it was trading below 230 and above 210. It's a very tight 10% range from March to the start of November. Then, bam, broke to the upside and just stalled out, and now it's back at the bottom of the range, even below the 200-day moving average, a fake breakout. And fake breakouts are a characteristic of markets that are towards the end of a bull market or making in the process of some sort of top. Those processes, though, can last for months. And I think that's really the explanation of what's going on in the stock market. Another sign of this is, as I mentioned, how so many stocks are trading worse than the stock market. But a lot of the ones doing this are the popular high flyer stocks, the ones that everybody is in. Just to name a couple and what they're doing. I mean, these are, to give people an idea here, stocks like PayPal are down 30%, Twitter 37%, Snap 38%, Lyft 39%, DraftKings 50%, Bumble 53%, Zoom 55%, Robinhood 58%, Lululemon is down substantially. Nikola is down 85%. Tenant Music, 76%. CRISPR, 60%. Alibaba, 55%. I can go on and on and on. But the last time I've seen so many big cap popular technology stocks down like this, when the stock market averages are not down, this is how much they're down from their high. When they're not down, anything like this, the averages, it was in the summer of 2000. And, this is the situation we're in. The fad stocks are not working anymore. They're losing people's money. And yet people are still, thinking these are the things to trade. For example, how crazy the trading is, on Friday, when the stock market had that decline over, this news of this South African virus variant, and it should be noted that it's unknown what the variant really means. It could actually cause symptoms that aren't that bad compared to the ones we've been dealing with around the world. That's in fact what the South African doctors have said, which would mean it's actually a positive for the economic situation around the world and for people. And so we just don't know. But regardless, even though we don't know, when people sold the stock market on Friday, Zoom jumped up almost 20%. And with these Zoom traders are thinking that everyone's going to lock down and they're going to be using Zoom again, and that trade completely fizzled out and it went right back down. And this is the thing going on when you have popular fad stocks that used to go up in a sustainable way, now only go up a day or two, then get back the gains. That's a sign of a market environment much different. And we've seen the warning signs, all year. When we saw these stocks first take their initial break in the first quarter, many of them never have recovered ever since and been trading very sloppy.
With inflation running rampant right now like it did in the 1970s, I'm just waiting for platform shoes and shiny makeup to come back, along with disco.
Well, honestly, I think that would be okay. If all that stuff can come back and the cell phone and Zoom and these sort of things can go away, I think it would be even better. I'd rather people go to the disco than put on metaverse goggles that this Zuckerberg is trying to market to people.
Yeah, stay at home but don't be alone.
Exactly.
Maybe he's going to use that slogan. We'll have more with stay at home but don't be alone. We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. In an environment like we're seeing right now, do you have a particular strategy that you think will work?
Well, I think one of the most critical things or important things happening right now, I like to look and try to position with a long-term perspective. That doesn't mean I just buy and hold and do nothing. But last year, we saw what I believe was a secular bottom in the commodity market. And secular trends don't just last a couple months, or 1 or 2 years, but like a decade. So I'm bullish on commodities for the years to come. I don't think the inflation trend is going to go away, and pullbacks are thereby buying opportunities, and we are getting a pullback as we speak. But I think another critical turning point is also occurring in the financial markets that's going to last for years too. That I don't think people are talking about it this way, but that's interest rates. You mentioned the prospect of higher rates next year, but if we think about the commodities making a secular bottom last year, when the oil futures briefly went negative, well, this would also suggest that interest rates have made secular lows and are going to go higher for the years to come. And interestingly enough, the corporate bond market yields, they made all-time new lows in the junk bond market just several weeks ago. So it wasn't last year. It was about the time of the last Federal Reserve meeting. Now, they pulled off that high, but they're still low, and the interest rate hikes haven't even come yet. So I think we're at a moment where rates are at rock bottom levels, and they're going to go up. They're not going to go up next week, but they will go up, even if, this variant is as bad as some are saying. It's not going to be nothing like what happened last year, and it's just a temporary thing, and life will go on, and they're not going to have all these mass shutdowns in the United States and most places, and it'll be all right. And so all it would do is delay the rate hikes, and it's not going to stop inflation. If anything, we've discovered that the supply chain problems that come also make inflation happen. So inflation's here, higher rates are now coming. So I think now is the time to take bets that rates are going to go up. And I'm doing that as a way to hedge my long positions. Specifically, I bought puts on the high-grade corporate bond ETF, LQD. Now, these aren't short-term options. These are leaps going out for several years. I'm not an advocate of trading options because I'm terrible at it. But I do think using puts against bond ETFs could be a good way to hedge one's portfolio and benefit anyway from what should be an underlying inflationary trend. I also have a small position in an ETF that goes up when junk bond yields go up, and that's the SJB ETF. And again, I'm not trying to day trade these, and they may reverse and, not go in the direction I'm talking about over the next week or two or even the rest of the year. But I think from here over the next couple of years, we are at a critical turning point. It's very difficult to time the exact price bottom on something or the exact day. But I think, say, with the oil, if you not in commodities, if you didn't buy an exact bottom but bought a month later, you'd be looking pretty good right now. I think that's going to be the case with shorting bonds, which means betting that the yields will go up.
Has energy been perhaps the surprise of the year? Because usually when we go into the fall, when the driving season ends, oil prices drop, but they didn't this year. Was that the big surprise?
Yeah, it's definitely. I mean, it surprised me. And commodities across the board did this. I mean, but oil almost always pulls back from July to about right now. And of course it didn't do that. It continued up in September and October. It's pulling back now. Oil is right on its 200-day moving average. So I would think that, when the stock market settles or bottoms, which could be happening today, I can't time these things exactly, that it'll be a good buy point for oil and energy stocks too. But, the commodities across the board seasonally tend to peak sometime in the summer and pull back, and they didn't do that. Coffee soared. Wheat prices were at a new high just a week ago also. So I think that's also evidence that we're in a very strong bull market when seasonal trends, which typically are bearish, aren't happening. So I think that's really worth making note of, as you did.
And with the infrastructure program in the U.S. being approved, that means a lot of steel, a lot of concrete, copper, aluminum, materials like that will be in big demand, won't they?
Oh yeah, for sure. And interestingly enough, I'm looking at a few of the larger ones. The material stocks, yes, they're down today, but they didn't fall as much as the Dow and S&P 500. They're still below Friday's low, for example. We're speaking on Tuesday. And they tend to go up when there's inflation. In fact, I tend to like to think of the 1970s overall as a model, and they were among the best performing sectors in the entire stock market. Everyone knows energy went up, but these material stocks did fantastic. Of course, gold and silver did too, but the material stocks, they also pay really big dividends for the most part.
One trend I wish would come back from the 70s, pickup trucks were incredibly cheap back then compared to a car. Now cars are cheap and trucks are incredibly expensive.
Yeah, I don't know why that is. I guess the price of cars has just been going lower over the years anyway.
But like I said, yeah, $100,000 for a pickup. Gosh,
that's crazy.
And I remember pickups in the 70s easily could be $3,000 or $4,000 less than a car.
Well, I mean, I guess the reason is, when I see pickup trucks from the 70s, they're for use. They're to pick things up, and they're like a utility vehicle, and now they're kind of like souped up SUVs. They're gigantic, and it's more for they're just luxury cars, almost luxury vehicles.
Yeah, I never trust a truck that rides like a car. I don't know. I grew up on a farm and in construction camps, and so I started driving trucks sitting on the lap of a truck driver when I was 5. I kind of know that kind of vehicle. Oh yeah, up in the woods in northern Alberta, there's no government officials. Hell, there's hardly roads. Mike, always a pleasure chatting with you.
Thank you. Great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.